Welcome back to my channel. Let me be straight with you. There's something happening in the UK property market right now that a lot of experts aren't openly saying. Across multiple cities, house prices aren't just slowing down. In some places, they've already started falling sharply. And if you're planning to buy, sell, or invest in 2026, knowing exactly where the risks are could save or cost you a huge amount of money. While mainstream headlines still talk about stability, the reality on the ground is very different. Beneath the surface, the market is splitting apart. Some areas are already seeing double-digit declines. Others are showing clear warning signs that a deeper correction could be coming. So in this video, I'm going to walk you through 10 UK locations where property prices look most vulnerable heading into 2026. These aren't small fluctuations. We're talking about meaningful, sustained declines that could reshape parts of the housing market. Some of these places might surprise you. Others have been showing cracks for a while. Let's get into it. Starting with number 1, prime central London. This one catches people off guard. You'd expect struggling towns to top the list, not some of the most expensive postcodes in the country. But right now, the biggest declines are happening in areas like Kensington, Chelsea, and Westminster. These are traditionally seen as some of the safest investments in UK property. But recently, that hasn't held true. Prices in Kensington and Chelsea dropped by over 20% in a year, while Westminster saw a fall of nearly 15%. That's not a minor dip. That's a serious correction. Even more striking, the vast majority of homes in some of these areas are selling below asking price, often with significant discounts. Tens of thousands of pounds are being wiped off average property values. And while it might seem like this only affects wealthy buyers, that's not the case. What happens in central London often impacts surrounding areas too. The core issue here is affordability. Property prices in these locations have stretched far beyond what local incomes can support. At the same time, changes in tax rules have made the UK less attractive for certain international buyers, leading to reduced demand. When a market depends heavily on external wealth and that demand weakens, prices can adjust quickly. And importantly, this isn't just limited to central zones. Nearby boroughs are also seeing declines, showing that the trend is spreading outward. Now let's move to number 2, Aberdeen. Unlike London, where prices have been driven too high, Aberdeen's situation is different. This is more of a long-term structural issue. Property prices here have been under pressure for years. In fact, average values today are roughly similar to where they were over a decade ago. The main reason is the local economy. Aberdeen has historically relied heavily on the oil and gas sector. As that industry faces uncertainty and reduced investment, it directly impacts jobs and therefore housing demand. There's also a large number of properties on the market compared to buyers, which keeps downward pressure on prices. While homes here may seem relatively affordable, that doesn't automatically make them good value. If prices continue to decline, buyers could still face losses after purchasing. Number 3 is Reading. This is a city that many would normally consider stable, especially given its connection to the tech sector and proximity to London. However, things have shifted. House prices have started to decline across multiple property types. At the same time, the factors that once drove demand, like office-based work and commuting, have changed. With more people working remotely, the need to live in expensive commuter towns has reduced. As a result, demand for buying has softened, even though rental demand remains relatively strong. That imbalance, rising rents but falling prices, often signals affordability limits being reached. Next, number 4, Oxford. Oxford has one of the highest price-to-income ratios in the UK. In simple terms, the average property costs far more than what the average resident can realistically afford. Even though price changes recently have been small, the bigger issue is sustainability. When housing becomes this disconnected from earnings, something eventually has to adjust. And unless incomes rise significantly, which seems unlikely, prices tend to correct over time. Number 5 is Bath. Similar to Oxford, Bath faces serious affordability challenges, especially for first-time buyers. Prices have largely stagnated, and some segments of the market have started to decline. Properties are taking longer to sell, and buyer demand has softened. What makes this notable is that Bath is a highly desirable city. strong culture, history, and lifestyle appeal. But even that isn't enough to support prices indefinitely when affordability becomes stretched. At number 6, we have coastal towns in Kent. These areas saw huge demand during the pandemic as people moved out of cities in search of more space and lifestyle changes. But that trend is now reversing. Prices have started to fall, and in some areas, the majority of properties are losing value. Changes in taxation for second homes and holiday lets have also reduced investor interest. When demand drops quickly in smaller markets, prices can fall sharply. Number 7, Slough. On the surface, price declines here have been relatively small, but when you look deeper, there are underlying risks. Property prices are still high compared to local incomes, and many buyers stretch themselves financially during periods of low interest rates. Now that borrowing costs have increased, affordability pressure is building. Combined with limited long-term growth drivers, this creates vulnerability if economic conditions worsen. Number 8 is Cambridge. This is another city with strong fundamentals, education, research, and a thriving tech sector. However, even here, affordability is becoming a major constraint. Despite new housing developments, demand is being affected by how expensive it is to live in the area. When skilled workers start considering other locations due to cost, it can impact both the local economy and housing demand. Number 9, Brighton. Brighton presents an interesting case because the data is mixed. Some figures show slight growth, others show decline. But beneath that, there are clear warning signs. Sales activity has slowed, properties are taking longer to sell, and both buying and renting have become extremely expensive relative to incomes. When nearly half of someone's earnings go toward housing, there's very little room left for price increases. Finally, number 10, smaller northern industrial cities. While larger northern cities often show strong performance, some smaller areas face different challenges. Higher unemployment, weaker local economies, and lower demand all contribute to potential risks. Prices may appear affordable, but that affordability often reflects limited demand rather than strong market conditions. If economic pressures increase, these areas could be more exposed to declines. So what does all of this mean for 2026? The key takeaway is that the UK property market is no longer moving as one. Different regions are heading in different directions. In the South, affordability is a major constraint. In some areas, pandemic-driven gains are reversing, and in parts of the North, economic fundamentals remain a concern. Interest rates, economic growth, and policy changes will all play a role in what happens next. For buyers, lower prices may create opportunities, but also risks if values continue to fall after purchase. For sellers, waiting may not always improve outcomes if the market continues to soften. And for investors, focusing only on rental yields without considering potential price declines could lead to unexpected losses. The biggest shift is this: the idea that property always goes up no longer applies everywhere. In 2026, success in the property market will depend much more on location, local economy, and long-term fundamentals. Because when conditions tighten, it becomes very clear which markets were built on strong foundations and which weren't. If you found this helpful, make sure to like, comment, and subscribe to my channel for more informed, data-driven property insights. Thanks for watching.